Welcome back to the deep dive. If you've been watching the markets lately, you might have that dizzy feeling.
Right, where the financial news ticker is moving so fast it feels less like information and, more like just white noise.
Exactly. And we've collected that noise for you. Our
Yeah.
source material today is, well, it's a colossal stack of current financial news, policy shifts, and corporate movers.
Basically a snapshot of the global market under some extreme tension.
So our mission isn't just to summarize, it's to filter that static and, give you the shortcut.
We're hunting for the key insights, the surprising policy pressures, those moments where major corporations are fundamentally pivoting their business models.
And ultimately how all of this is hitting your wallet right now.
What's immediately fascinating is the clear lack of synchronization.
A massive divergence in the market pulse.
On one hand, you have these pillars of the legacy economy, like ExxonMobil hitting record highs.
Stable cash-generating giants.
Exactly. But on the other hand, the cutting-edge growth names, chip leaders like NVIDIA and Micron,
And even the big banks.
and major financial institutions like Bank of America and Wells Fargo are seeing pullbacks, even when some of them post strong numbers.
That divergence really tells the story, doesn't it?
It does. It feels less like a synchronized market being lifted by a common tide and much more like a policy-driven, cost-conscious environment deciding which specific sectors,
And which specific models.
which specific operational models get to win. We need to unpack this because it is determining performance across the board.
And speaking of divergence and things, not quite working, we have to start with that widespread Verizon wireless outage.
A huge event, a massive voice and data failure across the U.S.
The sheer inconvenience was bad enough.
But what really raised alarms were customers seeing that dreaded SOS signal.
The 21st century panic button.
It is. And even reports of impacts on 911 calls. It's just a stark, real-world reminder of how fragile our infrastructure is.
I was just happy I wasn't waiting for a critical text back.
Yeah, but it shows how quickly we lose all connectivity when just one link in the chain fails.
Right, and while competitors like T-Mobile and AT&T confirmed their networks were running normally, the interconnectedness meant that calls to Verizon users were still failing.
Which highlights a critical, often overlooked point. In a market demanding resilience, a failure in one major system can destabilize the whole environment.
That's the perfect analogy for what we see in the financial sector.
It really is. Fragile infrastructure, like a Verizon outage, often foreshadows fragility in interconnected financial and policy systems.
Which is exactly what's boiling over in our first segment, the policy pressure cooker.
Let's start with the immediate heat, which is aimed squarely at the credit card industry.
The scrutiny on credit card rates is really intensifying.
It is, and it's being driven by President Trump calling for a dramatic one-year 10% credit card APR cap.
That immediately put the largest issuers, we're talking JP Morgan Chase, Bank of America, Citigroup.
Puts them on defense. This is high-stakes political finance.
But there's a crucial counterpoint here that often gets lost in the noise.
Right. The Washington Post reminded us that credit card users who are struggling often can negotiate lower rates directly with their lenders.
Especially if they have a decent payment history.
Exactly. It takes effort, but the power isn't zero.
That's vital context for the consumer. But what's fascinating is how the industry is already reacting. We saw Bilt, a newer player, announce a new card promo.
A one-year 10% introductory APR.
That is a highly specific policy-adjacent move.
It is. By preempting the political debate with a product, Bilt is effectively throwing down the gauntlet and saying, we can do this, why can't you?
That move will absolutely pressure established issuers like Capital One and Amex.
It forces them to consider how they manage political risk through their actual product line.
But let me challenge that. Isn't a 10% introductory APR only really relevant to high credit, high earning consumers?
The ones who might be switching cards anyway.
Right. Does that specific policy or product move really help the consumer segment that needs protection the most?
The segment paying 30% APR because of existing debt and lower scores.
Yeah.
That's the core tension, isn't it? Much of this policy pressure aims at the middle-class voter, but the immediate product reaction benefits the customer with high credit quality.
And the most vulnerable segment often remains untouched by these kinds of broad moves.
And these political headwinds aren't just hitting card issuers. They are swirling around the foundation of U.S. economic stability, the Federal Reserve.
Jamie Dimon, CEO of JP Morgan Chase, issued a pretty stark warning.
He said that political attacks on the Fed's independence could potentially lift inflation expectations and interest rates.
Why does the Fed's independence matter so much to a CEO like Diamond?
Because the perception of neutrality is its most important asset.
Right.
When political pressure mounts on the institution responsible for monetary policy, the market starts pricing in instability and unpredictability.
Which can push borrowing costs higher for everyone.
And we saw a very interesting defensive reaction to that instability. The DOJ probe of Chair Powell drew significant bipartisan pushback.
It did.
And that signaled that while criticizing the Fed is a favorite pastime in Washington, both sides recognize that maintaining the institution's perception of independence,
Keeping it out of the political wars.
yes, that's still a high priority for overall market stability. You can hate the policy, but you can't functionally break the institution.
Speaking of high-pressure policy, let's talk wealth and exodus, specifically in California.
We saw the state's financial policies drawing serious attention with the proposed one-time 5% tax on residents worth over $1 billion.
A very, very targeted tax.
It is. It's the ultimate game of high-stakes financial chess. The idea is to capture significant revenue from the ultra-wealthy.
However, the reported reaction was immediate.
Immediate. Reports circulated that Alphabet co-founders were moving assets, and the CEO of Box warned that this kind of policy would have concrete, negative business impacts on the state.
How long does the state calculate it will take for that wealth exodus to cost them more in lost long-term income than the one-time tax actually raised?
That's the billion-dollar question, isn't it?
It is.
The consequences cited by critics are clear. When you target movable assets and individuals with specific taxes, they just move their tax base elsewhere,
Which creates a revenue hole that can be hard to plug later.
proving that highly focused policy sometimes creates more problems than it solves.
Okay, now let's bring this down to the most tangible cost for the average person. Housing.
Housing affordability. The White House recently detailed steps to target those soaring costs.
What were they?
Yes. They announced two main actions: directing Fannie Mae and Freddie Mac to buy $200 billion in mortgage-backed securities, MBS.
And they also proposed limits on large investor home purchases.
Right. The logic is that by buying MBS, they inject liquidity and stabilize the market, and by limiting investors, they supposedly free up entry-level supply for families.
For our listeners who aren't steeped in bond markets, what exactly are MBS and why is $200 billion being questioned?
Good question. MBS are essentially pools of thousands of mortgages packaged together and sold as bonds.
Okay.
When Fannie and Freddie buy them, they stabilize the price of those bonds, which keeps mortgage rates lower. However, economists question the scope of that $200 billion.
Not enough?
In a multi-trillion-dollar housing market, that number might not have the systemic impact needed to significantly move the needle on prices or rates for the average buyer.
So the policy aims to solve a problem, but if the market determines the actions lack scale or legal robustness, the impact is minimal.
That's the challenge.
So transitioning from policy intervention to corporate reality, let's look at segment 2, corporate strategy, costs, and the future of revenue.
And we need to dive into those recent bank earnings. They provided a fascinating contrast, particularly in cost management.
Let's start with Wells Fargo.
Wells Fargo, for instance, missed profit estimates. And the specific driver wasn't weak revenue, it was a massive $612 million expense in severance costs.
Wow.
That drove up expenses and caused the stock to fall the most in 6 months.
$612 million in severance is not a rounding error. What does that signal about WFC's operating model moving forward, and maybe the broader banking sector?
It signals a massive internal cleanup. When banks face higher capital requirements and a tricky interest rate environment, they often try to streamline massive legacy operations.
So WFC is paying a steep price now to reduce headcount permanently.
It's a very expensive one-time Band-Aid designed to deliver structurally leaner profits in 2026 and beyond.
Meanwhile, Bank of America actually beat its Q4 earnings views.
They did, powered by strong net interest income and equities trading. They even guided for net interest income growth of 5 to 7% for 2026.
Which is good news.
It is.
Yeah.
Yet the stock still slipped with the broader financial sector pullback.
Which just demonstrates that good, forward-looking news can still get dragged down by the prevailing market sentiment.
And the ongoing skepticism that the entire sector faces, perhaps driven by those visible pain points like WFC's massive restructuring costs.
But the real structural pivot we are seeing is this overwhelming focus on reliable recurring revenue.
And nowhere is that more obvious than at Tesla.
Okay, let's look closely at this shift.
Tesla is going to stop selling full self-driving, the supervised version, as a massive one-time purchase.
Wow.
Instead, it will only be available as a $99 per month subscription. It starts February 14th.
This is a monumental strategic shift. Previously, customers would pay maybe $15,000 up front.
Right. Now they're pushing that massive, high-margin, one-off revenue event into a consistent, sticky monthly stream.
The goal is clear: increase the predictability and quality of their financials.
Subscription revenue is stickier, more reliable, and ultimately commands higher long-term valuation multiples than lump sum sales.
It's also about advancing their robotaxi readiness.
Ensuring all cars on the road generate continuous, scalable software revenue.
And that push for predictable revenue connects directly to the massive infrastructure deals happening in the AI compute space.
Which requires reliable infrastructure for those subscriptions to run on. We saw that OpenAI inked a $10 billion multi-year agreement with Cerebras
to add 750 megawatts of AI compute.
What's fascinating here is the sheer scale and the purpose. 750 megawatts is an immense amount of power dedicated to computation.
Put that in perspective for us.
Well, it's enough sustained power to run a medium-sized city or power hundreds of thousands of homes.
But let's clarify a technical term for our listener. What kind of computation is this focused on? We hear terms like training and inference.
Great point. When AI models are being built, that's called training. It takes colossal amounts of power up front.
Okay.
But once the model is built, the day-to-day running of that model, when you ask it a question, or when FSD is making a driving decision, that's called inference.
And why is that important in this deal?
This deal highlights the immense focus on expanding inference workloads. That's the sustained, reliable infrastructure needed to run the AI models 24/7.
So chip leaders like NVIDIA and AMD are watching this closely.
Very closely. It suggests the real long-term market isn't just selling the initial high-powered chips for training, but building the sustainable energy and data center capacity to keep those models running.
And while cutting-edge AI is demanding more power than a small city, traditional energy transition projects,
like offshore wind,
are running into bureaucratic headwinds and regulatory delays.
Precisely. Dominion Energy filed a lawsuit over a 90-day federal pause on its massive Virginia offshore wind project.
Though a judge allowed Arrested's project to resume.
True, but Equinor warned that these continued regulatory delays threaten project timelines across the whole sector.
And those threats aren't just about waiting. When a project faces a 90-day pause, the cost of capital continues to accrue.
And they risk losing specialized labor and key installation windows. It shows the deep tension between rapid infrastructure ambition and the slow pace of execution and regulation.
It's a battle of policy speed versus execution reality.
Indeed.
Let's transition now to segment 3, global trade and the consumer wallet reality.
We need to see how these dynamics ripple all the way down to your grocery bill and your input costs.
Let's start with a big picture look at global trade, specifically China's record trade surplus.
China's 2025 trade surplus surged to a massive $1.2 trillion.
A sign of immense export power.
It is, but the nuance is absolutely crucial for investors tracking China-focused assets.
Tell us the nuance.
Well, the surplus surged not because of overwhelming U.S. demand. In fact, U.S. shipments were weaker.
So where did it come from?
It came because exports to Africa, Southeast Asia, Europe, and Latin America were strong enough to offset that weakness.
Global trade is fundamentally diversifying away from the singular focus on the American consumer.
Exactly. So if we look at China-focused instruments like the FXI ETF, their drivers are no longer tethered primarily to the U.S. retail cycle.
They're being driven by a much broader set of global demand factors.
Correct. And that demands a new level of complexity in how analysts interpret Chinese economic health.
Alongside trade diversification, the U.S. is intensely focusing on resource security,
which feeds directly into the energy transition story. We saw a new presidential proclamation launched specifically to push for critical mineral security.
This involved launching negotiations and potential trade measures focused on securing processed critical minerals.
And why? Because these materials are the foundation of everything from batteries to defense systems.
So the U.S. is signaling that reliance on foreign sources is a vulnerability.
One that needs to be addressed through targeted policy and trade measures.
And that immediately spotlights domestic players, right? Companies like MP Materials and Lithium Americas.
Suddenly they become strategic national assets.
Exactly. Their valuation and long-term outlook are now significantly underpinned by political will to ensure domestic sourcing. This policy is essentially creating a premium on resource independence.
Shifting back to consumer goods, one policy issue that continues to prolong input cost uncertainty is tariff uncertainty.
We saw major consumer brands, Crocs, RH, Under Armour, all lag after the Supreme Court again declined to rule on the legality of broad tariffs.
That lack of clarity is highly costly for these businesses.
How so?
When companies can't budget for stable input costs because the legality of the duties they pay is still in flux, it impacts inventory planning, margins, and manufacturing decisions.
So that uncertainty is effectively baked into the price of goods you buy.
Because companies have to hedge the bets.
Let's talk about that consumer squeeze, specifically through the lens of Walmart data, which illustrates the uneven inflation experience.
The classic K-shaped economy we've been tracking.
When we talk about the K-shape, what we mean is that the top half of the income distribution
The top arm of the K
continues to see rising asset values and discretionary spending power, while the lower half, the bottom arm, is being dragged down by persistent, non-negotiable costs.
and the Walmart data illustrates this perfectly. Walmart basket prices rose about 5% on average in 2025.
And what was driving those specific costs?
Well, specific cost drivers included tariffs and weather, which boosted categories like paper goods and coffee.
Necessities that people can't easily cut out.
Right. But offsetting that, prices for volatile staples like eggs and butter eased significantly from their previous highs,
So it's a fragmented picture where you might celebrate cheaper eggs one week.
only to pay more for your paper towels the next.
What's fascinating here is that even as some prices soften, the overall consumer squeeze remains.
Yes, the sources highlighted that rising food and utility costs continue to squeeze lower incomes.
Which is why retailers focused on value, like Walmart and Kroger, are still grappling with these K-shaped demand patterns.
The lower half of the K is feeling persistent, unavoidable pressure.
That pressure remains substantial.
Right.
But we can end this segment on a positive economic indicator that suggests some relief is coming to the housing market.
Which is often the biggest cost facing families. Existing home sales rose 5.1% in December to a 4.35 million seasonally adjusted annual rate.
And crucially, prices moderated slightly alongside that sales increase.
That combination of rising transaction volume coupled with stable or slightly moderated prices creates a potential tailwind for large home builders.
Like D.R. Horton and Linn are moving into the new year.
It signals a market finding its footing and perhaps absorbing the impact of previous higher rates. Buyers who have been sidelined are starting to re-engage.
Which is a key stability indicator. So this was a dense but necessary deep dive into a market defined by tension.
Definitely.
We started by observing the core divergence legacy value outperforming tech and finance, and then tracked how policy interventions are colliding directly with major corporate restructuring.
From potential credit card caps to those painful severance costs at Wells Fargo.
That policy-reactive environment is defining global economics and shifting trade dynamics.
We saw that global trade with China's massive surplus is shifting decisively away from relying solely on U.S. demand.
Requiring strategic agility from companies and critical attention from consumers.
And the relentless focus on costs, whether it's for AI infrastructure or managing inventory under tariff uncertainty, is the central theme of 2026.
Absolutely. So what should you be mulling over tonight? Let's reflect on Tesla's FSD shift and that massive $10 billion compute deal.
Signed by OpenAI and Cerebras.
If cutting-edge, high-margin software is moving permanently from a massive one-time purchase to a reliable, recurring subscription model, not just for cars, but for the very infrastructure that powers modern business.
Does that signal that reliable, predictable, recurring revenue is now the single most critical metric for defining a company's long-term valuation?
Even over immediate blockbuster sales. And what does that shift mean for the next physical item you buy? Will everything eventually come with a mandatory monthly fee?
Food for thought as we close this deep dive. Until next time.